If you can get companies where both the fundamental agrees with quant, objective and subjective information both say the same thing, and the more that they say the same thing, that's where we've got a much better chance of being right. We never try and invest in something just to hedge something out. It has to have its own storyline. It has to have its own cycle going on. One upgrade is more likely to be followed by another one, and another one, and another one, right? And there's a whole lot of psychology and anchoring behind it, from management of companies to fund managers to sell-side analysts. That's why they're called upgrade cycles, because they go for a long period of time. Whenever you think you're smarter than the market, you're probably wrong. Don't try and second guess our process. We know it works. If you stick to it, you're going to outperform through that whole cycle.
Andrew, welcome to the show. Really looking forward to getting to know you more. And well done on 10 years.
Thank you, thank you.
What an interesting cycle you've been through, as we talked about crisis to crisis to crisis. But before we want to touch on that, let's actually go to the beginning. How did you get started in investing? Tell me.
Well, a lot of people in this industry kind of fall into it by accident a bit, and I probably put myself in the other camp, but I was focused on it right from school, really. I was interested in investments and finance, really from primary school. It kind of all started with my dad. He had a whole lot of these sort of odd lot shares that had come from spin-offs and stuff, and he gave us, all his kids, some shares. It was literally 15 shares in a company called Romatex, a textile company in South Africa, which I knew nothing about. But I knew I had 15 shares and they were worth about $50, and that was pretty exciting at the time. And I used to get home from school, read the paper, have a look at all the prices every day, see why it's moved. And of course it was the 80s, right? So it was going vertical until it didn't in the 87 crash. And that was even more interesting to me. How's my net worth, gone from $50 to $25 overnight? And anyway, I was really interested in what was going on. When we left South Africa a year later, I sold my 15 shares and got my money and bought myself a good old 80s boombox, which I had for years and years, and I was sold. This is a great thing to do. So at school I was very focused on accounting and economics and those kind of things, and eventually I got a scholarship to go work and study at AMP and do actuarial studies up in Sydney, and that allowed me to work at AMP for a bit in the holidays while I was studying. And actuarial is all about valuing future financial risk, which is really a great setup for being an investment manager. When I worked at AMP after university, I was in life insurance, which set in my mind I'd never want to work in life insurance as a career. But what I did do is it gave me a bit of access to the AMP Capital guys, and it was really interesting to me. And so when I left, I went to Merrill Lynch and I did one of these where you do a year where you rotate through the different divisions. My first division was investment banking in the financial institutions group, and I almost never left because I had actuarial background. They wanted someone who understood insurance. And so I stayed there for most of the time, except right at the end I got a little stint in their research team doing banks and the TMT, which is funny enough kind of what I do now. And that really got me excited. That's what I want to do. Through my actuarial contacts, I got a job at JB Were, which was probably the preeminent research house at the time, as the assistant insurance and gaming analyst. I'm not quite sure why those two were put together. I think if you get given insurance, they feel sorry for you, so they give you gaming as a bit of excitement. And then I became the senior analyst eventually in that firm. When Goldman's and JB Were merged, I left to go and join one of my clients, which was AllianceBernstein, who was restructuring at the time. They had a few issues coming out of the tech wreck and September 11, and they were rebuilding the team. And so I joined, Johan Karlberg joined, who's now my partner in Alphinity. And a year later, Bruce and Stefan joined, who are the other partners in the business. And that's how we met and got together.
Mate, that's quite an epic journey. Tell me about, throughout that whole journey, whether there was a particularly strong influence you had as far as someone who shaped your philosophy on investing, and maybe even wealth overall.
There's been many people along the way. The senior analyst I worked for at JB Were, he was an actuary as well, but he taught me a lot about research and doing the sort of the nitty-gritty of accounts and going through those. So he was actually a bit of a forerunner in terms of how to analyse insurance companies in Australia. So he was definitely an influence in sort of shaping me as an analyst. Johan, who I work with now, when we got together, he had a lot of investing background, managing money here and offshore, which I didn't have. What I had was the sort of quantitative analytical background And so, he taught me a lot about markets and what actually works in markets. And we went through a whole process of putting our philosophy and process together, which was actually fantastic for me because it went from basic principles, okay, what works? How do we find that? How do we get these companies? How do we analyze them? What tools do we need? And we built it up from the bottom, and that in itself was just an incredible learning exercise.
Okay, great. So 10 years at Alphinity, well done. And like I mentioned in the beginning, crisis to crisis. You started just as the recovery phase from the GFC, and the US was still in a terrible shape. Eurozone debt crisis, the downgrade of the US AAA rating, Brexit, Trump, who could have seen that? And now COVID. What an extraordinary cycle of investing. And I guess, if we think about the undercurrents of all that, we've had such massive technological changes and structural shifts in monetary policy and fiscal policy. So throughout this decade, what have been some of the, maybe 1 to 2 changes to your investment philosophy that you've learned from this period?
Our philosophy has actually been incredibly stable the whole time. In fact, even going back to when we set this thing up in terms of the philosophy and process in 2003, 2004 as a team, I think it's survived the test of time because, so it's the way I kind of think about it, it's strict enough to keep you on track to know what you're looking for and what you're doing, but it's flexible enough to actually adjust when the market changes. The big changes, I know we've gone through a lot of crises, but big changes in what's driving markets actually don't happen that often or sustainably. There might be big sharp moves intermittently, but they don't actually happen in a sustainable way that often. But when it does, you need to be flexible enough to pivot. And our philosophy allows for that, and our process allows for that. So we haven't actually changed a lot in what we do. I'd say, we've learned a lot in terms of how the stocks we look for adapt to different markets. That's you learn that all the time. But I think one of the great things of having gone through this long period, and then the 7 years before that, which of course came off the back of September 11 and the tech wreck, the rise of China, the GFC. So we had a bit of experience in that beforehand. Was actually to trust the process because it does adapt. It is flexible enough to move. And so when you think I always say to the guys, whenever you think you're smarter than the market, you're probably wrong. So don't try and second guess our process. We know it works. We know what we're looking for. Focus on that. And we've seen it 4, 5, 6, 7 times come through different cycles now where it works really well. And if you stick to it, you're going to outperform through that whole cycle.
So trust yourself, back yourself, stick to the process.
That's right. Yeah.
Okay.
Yeah.
Okay. We'll explore your process in more detail
Sure.
A bit later into the conversation. But let's turn to what's happening today. Who would have thought that after a 40, nearly 50% crash in markets, that at least in the case of the US, we'd be back to pre-pandemic highs, and in Australia we've made an amazing recovery as well. Now, obviously, we've got 2 things happening here: a government-funded global economy, and then we've got the pandemic. Yeah. Do you feel there's a disconnect? What's your take on what's happening here?
Yeah, I mean, there is a disconnect when you look at it sort of from a top-down perspective, but that kind of disconnect isn't unusual in markets. So markets look forward, right? And typically economic factors are looking backwards, and so the market is trying to anticipate what's happening. So I'm not that surprised that there's a disconnect. The size of the disconnect perhaps is surprising me because it implies what's being priced in, right? So, when I try and think about, okay, well, what does this mean in terms of where things are actually going? Firstly, I'll say I don't know. We don't spend a lot of time trying to think about is the market going up or down this week or next week or what have you. As far as we're concerned, that's another thing to get wrong. There's a lot of assumptions we need to make, and that's not one we need to base our portfolio on. We do it much more bottom up. But we care about what the market does and the drivers behind that. So, if to us, the way we kind of think of it is in a framework like, to know where the market may go, we have to actually understand why it got here in the first place. And so you think about what's been driving the market to date, to this point, it's 4 things as far as I can see. It's the obvious one is interest rates, right? Monetary policy. Interest rates are low. There's lots of liquidity around. Low interest rates do drive valuations, all else being equal. I'm not sure all else is equal, but they do drive valuations up. Lots of liquidity looking for a return. Equity markets are liquid places to get return. So that's clearly been driving the market. Is that going to change anytime soon? I don't think so. If anything, the Fed's told us it's going to be lower for much longer. We know, all the central banks have signalled now. We all know that if there's going to be any kind of dip or volatility in the markets, they're going to step in. So that's not going to change. Monetary fiscal stimulus, unprecedented, gets thrown around, but it's true, right? It's huge. And it's doing its job. It's actually holding things up in the economy. I think it's masking what's actually going on, but it's holding things up. And there's likely to be more of it before it goes away. Again, is that going to change? It will. Eventually, it'll fade off. So I think there'll be more before it fades off, but it will fade off, and then we will see what's actually happening underlying in the economy. But that's not going to change in the next few months. The third thing is economies opening up. So really, back from almost May now, various economies around the world sort of had their peak in infections, and then they've started to open up. Now, even though we've had second waves and third waves and what have you, if you look globally, things are still actually improving and still opening up. It doesn't feel like that in Australia because we've got Victoria, right? 25% of our economy is in serious lockdown. And so Australia, which started off probably better than everyone else, is probably fading away now relative to everywhere else, which is still opening up and still getting better. I had a look at the Citigroup has an economic surprise index for the US, and it is off the charts, positive.
Right.
So, things are turning out better than people expected. And when that happens, it drives prices up. People get more excited about how things are looking. Again, is that going to change? Well, we don't know. That's, I think, one of the big unknowns. Is growth going to get disrupted? Is that, it's not quite a V shape, but maybe a swish, but is that going to be disrupted at some point because of a second wave or a third wave or something else? Does growth just settle at a lower level than everyone expects? I think if any of those two things happen, that'll hurt the market. And then the fourth one's a vaccine. We were talking about this in the office the other day. I think it does seem to be that the market had got to a point where it was kind of just assuming that a vaccine is going to arrive by the end of the year. That vaccine is going to be rolled out really quickly, and people will be travelling again next year, and there'll be herd mentality within a reasonable amount of time. Let's hope that happens, but we don't know that's going to happen, and there has to be at least some probability that there's some hiccup along the way. We saw today a hiccup with one of the vaccines, right? So we don't know, but the market's kind of assuming that's going to happen. Again, is that going to change? Well, we probably don't know until the end of the year, but any hiccup in that means the market's going to probably pull back. So if I look at those four things in the next few months, it's hard to see much changing. But if I look into next year, you're going to have to expect some volatility because not everything's going to play out as positive as the market seems to be pricing in. If I look at market valuations let's go to FY22 when there's a bit more normal earnings, the market looks pretty stretched, right? So it tells me a lot's being priced in. Now, that may happen, but the probability is something's going to come up and muckle up along the way. And so it's hard, the way I think of it in that framework, it's hard to get too bullish the market from here. Again, I'm not massively bearish to the market, but it's hard to get too bullish. I think what we more likely see is just a fair bit of volatility between now and into next year.
Okay, it seems like you've taken a balanced approach.
Yeah.
Kind of making bets if you're right, but also hedging them in case a vaccine doesn't pan out. Maybe talk to me about some of the key themes you've got going.
Yeah, look, I'd say the key theme we've got going is, again, we never try and invest in something just to hedge something out. It has to have its own storyline, right? It has to have its own cycle going on. Now, great if it gets the benefit of what's happening. That'd be great. So, like a Fisher and Paykel is definitely a beneficiary of COVID. Ventilators are on high demand, they produce them. But as part of what's been going on, their nasal high flow product is also getting used more and being seen as a really good frontline, usage, and people are actually implementing more and more of that product, and therefore there's a longer story. It's not just about COVID ventilators. Everyone knows that the ventilators are going to go up and down, but actually there's something here that's going to be more long lasting. That's the kind of thing we're looking for. Something like a QBE, right? So a QBE insurance company. It's a company that's had a lot of issues in the last decade or more, and just recently actually lost their CEO. But before that happened, that CEO had been fixing up a lot of the issues in the business. So putting in much better underwriting practices, selling off the poor businesses, and really setting the business up. Now, you call it good luck, but what we're seeing now is pricing in that industry start to move quite significantly. And I covered QBE as a sell-side analyst back in 2000, 2001, the last time this happened in a big way. And that was September 11 happened. It was very similar. You had insurance companies struggling a bit because pricing had been poor for a long time. Suddenly you got this big event called September 11, and pricing took off. QBE raised money, had a fantastic, almost 6-7 years performance out of that stock. We then had 13 odd years of terrible pricing, and now we've got COVID, and COVID is September 11, times a couple in terms of magnitude, and we're already seeing pricing start to move. So with pricing starting to move, QBE set the business up in a way to start, being able to leverage the benefits of that. That's kind of its own cycle. That's happening regardless of what else is happening now, because the industry's finally turned the switch on. And so it's kind of everything we're looking for, right? It's the market's underestimating the earnings expectations of that company. Because of their history, the valuation is actually pretty decent for QBE, unlike a lot of things in the market. And they have raised capital, so their balance sheet actually looks pretty good. So it's that kind of thing that we're looking for.
Notwithstanding what's happened to the CEO recently, but these are two companies, Fisher & Paykel, QBE, acting within their own cycle, and you like them for that reason.
That's right. I mean, something like a Macquarie, which we've spoken about before at Livewire. I mean, if anything, I think that the outlook looks even better. Now that's been helped by what's happening because interest rates are going to be lower for much longer, and that's really going to benefit their business. You would think, for example, that governments going into deficit are going to look to sell assets at some point, and infrastructure is a great one to sell, and Macquarie's got the capital there to help out. They've got lots of firepower. So that's all great. That's been helped by what's been going on. And then you've got on the side, you've got this green investment business that they've been building. They've timed it perfectly again in becoming effectively the world's biggest manager, investor, owner, developer of green energy. And that's a freight train that's got its own momentum, and it's going to keep going, and they're right at the front of that. So again, benefiting from the environment, but got its own story going on at the same time.
Let's turn to your process. So one of the hallmarks that you pointed out of your investment philosophy is the consistency. You've built a process, you trust the process. Maybe explain what the process is. And I think, when I look at the performance, you've outperformed nearly over all periods, but the important thing here is the risk management. So the volatility has been more stomachable, if that's a word, than maybe the index or some of the higher growth managers. So how have you managed both the consistency, but also avoiding those big drawdowns?
Yeah, and that's by design, I'd say. You've got to go back to 2003 when we literally sat down with a blank sheet of paper and said, okay, let's design this. What works? What tools do we need? And our first client was a life insurance company. It took a very long-term view, and they basically just said, don't blow up, right? You don't have to be number one in the tables every month. Yep. What we want you to do is over a long period of time, just incrementally add value. And if you do that, you're going to be one of the better performing managers, and you're going to do it with lower risk than everyone else. Sure. And so that was our sort of mindset, right, when we were sitting down trying to design this thing and put the tools in place. So risk became a big focus of us. How do we control risk? So with that as background, maybe I'll step back and say, okay, what was our underlying philosophy when we looked at this? And our underlying philosophy, what we call it earnings leadership, right? We're trying to keep it simple. It's which companies in the market have earnings upgrades? Where's the momentum in earnings in the market at that point? And can we find those companies? I can show you over just about any period of time through any different market that if you can consistently invest in the companies that are beating market expectations on earnings, you're going to outperform the market. Now, finding those companies is hard, but if you can find them, and then if you can wrap it up with buying them at a good price, so value, and overlaying it with quality, which is a risk control measure, we think we've got a winning formula. So the way we describe ourselves is we invest in quality undervalued companies in an earnings upgrade cycle. And those are the three things we look for. So I'll take you through those three. So value, that's sort of self-evident. We want to buy stuff at a good value. We want to get a good return. But there's actually more to it than that. Value is actually a really good risk measure. When you've got a bit of momentum or earnings momentum in your process, you really want a way of getting out, a good signal to tell you to sell. Otherwise, it gets quite enticing to hold really good stocks for forever until they're not. And so value is a really good way of trying to stop you getting caught in the growth trap. Now, we've all talked about the value trap a lot. Growth trap's worse, right? The growth trap is you're investing in companies that are fantastic businesses, They're growing really strongly. Everyone loves them. Everyone's on board. And guess what happens? The PE of the company gets higher and higher and higher, right? So more people get on board, and nothing's ever going to go wrong, right? There's a few of those companies around at the moment, but we can always find those companies. There's always something where it's just brilliant. And of course, something always goes wrong. And even if it doesn't go actually wrong, the market just gets ahead of itself. So they think this is going to grow 50% per annum forever. And maybe it grows at 30%, which is still great, but it's priced for 50, right? And what happens when that happens for growth companies is, so earnings come down. So people go, oh, I got my earnings wrong. But then they say, oh, what PE should I put on those earnings? It should be lower than I had before because I'm unsure about earnings now. So you get this double hit. You get earnings down, PE down, and that's why when growth companies miss by 5%, they don't fall 5%, they fall 20%. And so, missing that risk, that growth trap is key to us, and we use valuation for that. Go around to the other side is the value trap, right? So the value trap is, as we know, buying really cheap-looking companies, and they just stay cheap because they're cheap for a reason, or they take forever to turn around. Who knows? We try and avoid that risk as well, and that's why we use earnings momentum. So we say, well, actually, has something changed in that company? Yeah, it's cheap, but has something changed? Where's earnings going? What are market expectations? Have earnings expectations got down low enough that they can actually start to beat those earnings expectations? And if you actually wait for that, you miss out on a whole lot of risk of just sitting there underperforming for years and years and years. And the reason it works is that once an earnings upgrade cycle starts, we get what's called serial correlation. So one upgrade is more likely to be followed by another one and another one and another one, right? And there's a whole lot of psychology and anchoring behind it, from management of companies to fund managers to sell-side analysts. But you see, that's why they're called upgrade cycles, because they go for a long period of time, right? And downgrades happen the same. So if you can actually wait and miss out on all that sitting around underperforming period, and yet you might leave a little bit on the table, but you actually get most of the upside by then following the earnings upgrades. So our idea is miss out on the growth trap, miss out on the value trap, invest in the middle in quality companies. So quality is the third one, which is all about risk. It says, are the earnings that you're talking about in valuation and in momentum, earnings momentum, are those earnings real, or are they made up, or are they been fudged on the balance sheet? It just takes out, massive swings where you invested in companies that look really good, but the earnings are sort of evaporate, right? So quality is all about managing risk. So I think if we can get those three things right, you're going to outperform consistently and through different cycles. And that's getting back to what I said before, where it's a tight enough process to keep you on track, but it adjusts when markets adjust. When earnings leadership changes in a market, so suddenly the market goes from growth stocks to cyclical stocks, and it's sustainable, well, the process moves because earnings leadership changes, and we're going to look for those companies now.
So avoid the growth trap, avoid the value trap, invest in the middle. I think you spoke to some of the stocks in the middle. I got to ask, what do you think are the biggest growth and value traps in the market right now?
Look, I mean, there's a change all the time, but there are a number of tech stocks, sort of the obvious ones that we talk to on the sort of growth trap side. Frankly, they could be there for a long time before there's any kind of reckoning. But again, we don't have any problem with the business models of these companies, right? These are great businesses by and large. They've got great ideas. They've executed well. They've got a global potential market. So these are all great companies. My issue is actually more about what kind of risk is being priced, and sort of as we go day by day, it's less and less risk is being priced into these things. And I'm talking about from competitive risk to regulatory risk, and to whether people are estimating their markets even correctly, right? And because all their value sits so far out, we're talking like in their terminal value, right, 10, 15 years, because a lot of them don't make money now, so we're guessing, right, a long way into the future. Because we're guessing a long way into the future, small changes in assumptions make big changes to valuation. Yeah. So that's why they're actually really volatile now. Typically at the moment they're more volatile on the upside, but in the last 2 years, I mean, Afterpay's halved twice. Look at WiseTech's volatility. Appen was off 15%, 3 weeks ago. They can be quite volatile. So I think what you want to do is you want to bide your time if you want to buy into these stocks. I mean, the way I think about it is, if you want to, with certainty, price in massive assumptions in 10, 15 years' time, think about what's happened in tech in the last 10 or 15 years. Yeah. Right, 15 years ago, there was no iPhone. Nokia was the king, right? This was 15 years ago. but we being asked to price some of these companies on massive assumptions in 10 or 15 years' time in the tech market with certainty. That's the bit I sort of struggle with. And funnily enough, I was questioning an analyst's sort of fundamental assumptions and valuation technique the other day, and I was told in no uncertain terms that I just have to stop thinking like that, because that's not the way the marginal buyer is thinking, which is revenue multiples. I must admit, I'm a bit too old-fashioned, but I do struggle with that concept. There is a base valuation we need to think about, and the problem with using revenue multiples or the like is, these stocks can halve and still look expensive. When you trade on 20, 30 times revenue multiples, you can halve and still go, wow, that's quite expensive. There's nothing there to sort of back it up. So that's sort of a general comment about sort of growth traps. I would say though, just putting technology aside for a second, that we still look at it company by company. So we have owned some tech stocks, right? We have owned Appen in the past. We have owned Megaport, for example. But you do want to look company by company and make sure you can justify the valuations and bide your time and actually buy them at the right price. Then you get a decent return without the volatility.
So we've covered a lot of stock ideas. We've talked about your process. Tell me about the way you research things and bring it all together. So something you believe in is using all types of research and not necessarily being hinged to a particular style, growth, value, so and fundamental and quantitative analysis as well. So walk me through maybe how the team puts an idea together. So as I say, when you think back to the philosophy, it's quite a compelling philosophy, but the question is then how do you find those stocks, right? And so we take quite a pragmatic view right from the start, and I think it came from the fact that, again, Johan had this really fundamental background. I had a bit of a quantity background, and when we came to sit down and say, okay, how do we find these stocks? Our view was, well, there's a lot of information out there, right from sort of fundamental analysis right through to quant side. And if you look at across the industry globally, really, it's quite rare where people actually bring those together properly. So after the GFC, a lot of quant funds termed quantamental, but they'd add a bit of they don't believe it, right? Because it's all fundamental analysts are all biased and they got inherent issues with their research. So if you're a quant guy, why would you rely on that? And if you're a fundamental analyst, pure fundamental analyst, you say, well, how can these quant guys really know anything about the company? I do all this research on a company. There's no way they're going to know. So sometimes you have screens on fundamental, and so either side kind of doesn't like each other. Our view was, well, hang on, there's a lot of information here. Different points in the cycle you can point to, hey, quant works really well here, fundamental works really well here. Can we just bring the best of both worlds together? There's this whole man and machine thing. If you get the best of man and machine and bring it together, it works better than either one alone. And we kind of built that into our whole process from the start. I think if you start trying to build that into a process, into a company that hasn't had that before, it's really quite difficult. But we just started. So everyone who's joined the company, that's just how it is, right? And we don't see quant as this black box, punch in numbers and it spits out stuff. That's not how we do it at all. We actually work the other way around. We said, okay, what works, right? Earnings upgrades, cash flow quality, price momentum, balance sheet accruals. We work through things that what actually works to tell us where they are in their life cycle, what quality balance sheet they've got, and then we went and tested those to make sure they work through different cycles. And then we said to the team, okay, in your fundamental analysis, don't just do fundamental analysis, test it against the objective data. There's a whole lot of objective data telling you might be wrong. Well, don't ignore it. Go and use it and say, well, okay, maybe I am wrong. What am I missing here? The great thing about having but two sides of research, or using the whole spectrum of research, is that I may know nothing about Ramsey, let's say. But what I do know is I can straight away pick up all this objective data that tells me a whole lot of stuff about where the company is in its life cycle and how it's going earnings-wise and balance sheet. And when Stuart, who covers that stock, wants to buy it or sell it, or he'll come up with a view and he'll present it to the company, to the rest of the analysts, and I'll sit there and say, okay, that sounds really good, but what you're saying about earnings is completely different to what I'm seeing on an objective data. Right? Why is that? And now he knows how that works, so he would have gone and done that work already to work out why it's different and why it's sustainably different. Or put it the other way around, maybe it actually completely matches what he says. And I say, okay, that gives me a lot of confidence that he's done a whole lot of work that matches objective data. And so what we find is, if you can get companies where both the fundamental agrees with quant,
So objective and subjective information both say the same thing, and the more that they say the same thing, that's where we've got a much better chance of being right, that company is the kind of company we're looking for, about being in an upgrade cycle and sustainably so. And that's how we think about bringing it all together. And again, to us, that actually what creates a lot of the consistency that we have. Different things work differently at different points in the cycle. Value cycles, growth cycles, core, neutral cycles. But if you've got all the elements that you can play on and question yourself, if you can get the best of both worlds, it tends to smooth out the bumps, and that you don't have those big drawdowns because you're not sort of hooked to one style. What we're hooked to is earnings leadership, and how we find that, we don't really care where the information comes from.
Thanks for sharing that. That's a great level of detail in the way you operate. Andrew, thank you so much for coming in today. Really appreciate your time. Well done on 10 years, and I wish you more success for the next 10 years.
Thank you. Thank you very much for having me.